Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network. I hope you'll hit subscribe. This is a place where you're learning not just about economics and finance, but actually how to apply that in investing. So we're going to do a series now on stock selection. And we're going to start out with something that does not get nearly the attention it deserves, which is earnings quality. Over the long run, what drives your returns are the earnings of the company. That's what this is all about. Companies produce earnings. They produce profit or gross profit or margins. There's different ways or cash flow. There's different ways to measure it, but they got to do some kind of more money coming in than money going out in order to have money to give to you. They give you money in the form of dividends, which is basically just a check the company sends to you for being an owner. Hey, here's a share of profit. We're sharing the profit with you. They have another way they do it sometimes, which is they buy stock from the owners. That's called a stock buyback. So they go out there in the market and they buy the stock. So that drives up the price of the stock. So that's another way you can get paid. But those are the ways you get paid. But both of those things come out of earnings. If you don't have the earnings, then a company cannot for long continue to pay its dividends or do stock buybacks. So we're going to look at certain kinds of ways of measuring the quality of earnings to help make you a better investor. In this particular video, we're going to look at gross profits to assets. Gross profits are profits, but a wider definition of profits. Whenever you're defining profit, when you're calculating it, you've got money that comes in, that's revenues. You got money that goes out, that's expenses. But what do you count as the money that goes out? There's all sorts of decisions about which of those expenses to count. Well, depending on which of those expenses you count, you end up with a different definition of profit. In this particular case, we're counting the expenses that are directly relevant to the business. Cost of goods sold, mainly. So when you sell a car, you have revenue from the car. Well, hold on. That's not, that $50,000 revenue for the car is not gravy. You had to build the car, and that was cost. So you take the $50,000 that you got by selling the car minus the, just making numbers round, $40,000 it took to build the car, cost of goods sold, and sell it and deliver it. And the difference is the $10,000. So that would be basically an example of gross profit. So what are we doing with gross profit? Well, we're dividing it by the assets of the company. What are assets? Stuff the company owns. The focus here, of course, is stuff the company owns in order to run the business. After all, why should it own anything else other than the assets that it needs to run the business? So what this is saying is, for each dollar of assets, for each dollar that the company has invested in itself, this is an internal rate of return, meaning this isn't what the investor gets. We're looking inside the company. The company is making an investment decision as well. It's deciding whether to invest in a new factory or some new equipment or a patent or other forms of intellectual property or land. It's investing in something. Those are the assets. For each dollar spent on an asset, how much profit do you get? In this case, gross profits. How much profit do you get that's directly relevant to the operation of the business? All right, so that's what gross profits to assets is. So what are we using that for? That's not this number. This number is going to be something else. We use this to divide them up from best fifth to worst fifth. So what we're doing is we're looking at any given time, all the companies in the universe, and this is a big universe that we've used. This is not just the S&P 500. This is thousands of companies that we're looking at. Large cap and mid cap and small cap, big companies, middle-sized companies, and small companies. And we're saying, let's take the best of the best and put it in this bucket. Now we're going to put the second best in a bucket that's going to go here, and the third best and the fourth best and the fifth best, which is also the worst. And then we're going to say, what happens the year after in those companies? What kind of return do you get in the following year? And what we see here is that when you look at the companies with the highest gross profits to assets, that is the companies whose managers are able to turn assets into business-related profits This isn't they, they sell a division and they get a profit on that, or, they happen to sell a building they don't need anymore and they get a profit on that. This is profits having to do directly with the product that the business sells. So the companies that are best at turning assets into profits, another way to say that is the companies that are best at deciding which assets to invest in, which assets to buy in order to generate profits. That's the average return in the subsequent year. And that looks pretty good. What if you go for second best? Well, that's actually a little better. This is not a linear factor. In other words, this isn't smooth. This works in some ways and it doesn't work in others. The best doesn't actually give you the best return. Now, that's when you're looking at the whole universe. Maybe in the future, we can do something that looks at how large caps, big companies act differently than most companies, and you'll see it does become more regular. Now, if you go for the mediocre, you have a pretty big drop-off. You got another drop-off if you go for second worst, and then a really pretty big drop-off if you go for the worst. So the difference between best and worst is considerable. Now, I happen to have a little model, and we can do a future video about this as well, where I say, let's make a portfolio out of these two. But since this is the most extreme one, let's double count that one. And then let's make a portfolio out of these two. And since this is the worst, we double count this one. And then we look at the differential between those. And it is substantial. The top two really beat the bottom two. And the middle is, well, in the middle. All right. So what that means is earnings quality matters. In this particular case, it's earnings quality, gross profits to assets. Again, this is not your profit as an investor. This is the profit the company's making. Now, ultimately, that matters to you because you're an owner and that's how they pay you. So what this asks is this company good at managing its assets? Is this company good at using your money? You're the shareholder. It's your wealth to generate gross profit. If it is, and for some strange reason, if it's the second best, that we'll get into that later, has more to do with the difference between how stocks in general work as opposed to how large company stocks work. What you see is in the past, nobody knows the future, no guarantees about the future, that it gives you a substantial advantage when it comes to investing in stocks. By the way, this is all United States stocks. We haven't done this for international, which is a research project worth doing, but one thing at a time. Anyway, I'm Jerry Bowyer. You've been watching the Eagle Investing Network. Make sure to subscribe. Surely you've subscribed by now. If you haven't, it's long overdue. And it's also long overdue to share this with somebody who could also benefit from the knowledge. As always, thanks for watching.